Hi there everyone, Rob McGregor here, and welcome to the end of September edition of On Track. I'm recording this on Thursday the 29th of October. It's a beautiful day on the Sunshine Coast, and just a big g'day to my friends and clients in Melbourne. Good to see you allowed outside, and a bit of life coming back into Melbourne, well overdue, and feeling for you all. Going to cover all the usual stuff today, updates on the markets, particularly update on the budget, just the usual quick general advice warning. This presentation, this monthly video is designed for clients of McGregor Wealth Management, and it's focused on you and your investments. For those of you listening who aren't clients, you may find it useful, but before you act on anything in this presentation, you should get advice that's specific to your own circumstances. So what we're going to cover today, we're going to have a look at the big economic news. The main one for the month for us, and the big one to focus on, was the budget. The budget gives us a chance to see what Treasury's thinking. I mean, this is their forecast. There's a lot of smart people there, so we watch this very closely to get an idea of their forecast. And also a very important RBA update. The RBA made a significant change to the way they target inflation, which I'll talk about. I'm going to talk about what's happening in the markets, which are fairly stable, and put in perspective the news that's going on at the moment. So as I said, the budget, and I'll talk some more detail in a minute, but there was a record stimulus. What that means is record deficits, and much needed. So we're in this pandemic-induced recession. The only way out of that quickly, without lots of pain, is for the government to spend money. And the RBA to also stimulate through some monetary policy. So the budget delivered on that. It was a good budget. It's going to scare some people into debt. I'll put some of those numbers in perspective. And as I said, RBA, their shift in focus for inflation, you'd be familiar, the RBA's job is to try and keep inflation in the 2 to 3% band. Now that means if they think it's heating up, they'll often take action like increasing interest rates before it gets to the other side. But the significant change that they've made is they've said they will not lift interest rates until it's above that 3%. So that's massive, because in the past what would happen as inflation started to go up, they would start to lift interest rates. So they're going to let the economy go at full throttle as it comes out of this, and there's plenty of capacity. We're going to see interest rates probably drop in the next month to 0.1%. We're probably going to see term deposits below 0.5%. We're seeing a flattening of the yield curve. They're pushing 10-year government bond rates down to below 0.5%, and that's to keep the Aussie dollar down. If we let our 10-year government bond rates be higher than, say, the US, then that leads to investors, international investors, putting money into Australia, and our Aussie dollar goes up, which we don't really want, unless we're travelling, and we're not travelling. But that's another story for another day. The big international news is the US election. Biden's got a lead in the polls. It's crazy city. It's like a bad reality TV show, but there's a big but there. We know that Clinton had a lead in the polls last time, but Trump got home. The US election, the college system over there, the college electoral vote, is very complicated, and there'll be half a dozen to a dozen states that will make all the difference about what happens. So we'll know this time next week. The US presidential election is on next Tuesday, same day as our Melbourne Cup. So it's going to be fascinating to watch. And either way, it's probably not going to have a huge impact on the market. My good friend and colleague Emmanuel Caligaris from the GPS Investment Committee, his thoughts are if Biden wins, the market might go down, but then it will go up. And if Trump wins, the market will probably go up, but then it'll probably go down. And there's a lot of reasons for that. But what the US markets are looking for is stimulus. And whatever happens, whichever way, if Biden gets in, that stimulus will be big. So the market will come around and like that. If Trump gets in, there'll still be stimulus. But generally the market is more happy when there's a Republican in government, because they're less afraid of new taxes and other things. But in this case, the market will be pretty comfortable with both, but there might be some preliminary reactions. What the market won't like, if it happens, is a really tight race that ends up in court. That will cause a little bit of short-term focus, but ultimately the market looks through politics, and it looks to profits of companies and the economy. So barring anything that's going to have a massive impact on those things, you'll see the market will shake around a little bit, but it will get back to the general trend, which I'll talk about. You see some of the rates there for interest rate type things, incredibly low. As I said, we expect 1-year term deposits to get down below 0.5%. We're just starting to see mortgage rates in the high ones. I've seen 2 to 3 ads of 1.9%, and we think it's a high probability that somewhere in the next year you're going to see mortgage rates, particularly for good borrowers with less than 60% loan to valuation ratio, so that aren't borrowing a lot compared to the value of the property, you're going to see them offered loans of 1.5%. And this may come from areas outside the traditional mainstream banks, which will put massive pressure on our Aussie banks as well, and good competition for borrowers. Not very good for retirees who are relying on term deposits. Most of our retirees rely on a balanced to growth portfolio, so you're okay. But if you know of anyone who's relying on term deposits, feel free to point them in our direction. The biggest risk for retirees who've been relying on term deposits is they start chasing investments that are too risky for them. And you've got a sad situation now. Someone who had $2 million in savings and they were living off the interest on that will now only be getting $10,000 a year. They of course qualify for no age pension, so a couple who had spent all their money would get $37,000 a year, and that $2 million so-called rich retiree would only be getting about $10,000 a year. So it's tricky for those people. Now they need to step up into the type of investments we talk about with you. Speaking of which, here's the results. So the end of September was a negative month, but since then the markets have risen strongly. So all the negatives from September are gone as the markets jumped up, and I'll go through the individual markets shortly. So even though September was negative, that's been washed away pretty quickly. When you look at the 5-year returns here, they're returns that are hitting or extremely close to hitting our long-term targets for our plans. Now that's really critical, because the most important thing to us is that we can help you plan and spend confidently, knowing that your portfolio is going to deliver on what it's planned to do. And despite this pandemic producing a major downturn, the long-term returns are actually sitting fairly well. If you look at the last year, I can't, as ever, reinforce the importance of diversification. Gold there at the top of the ladder, Australian shares at the bottom of the ladder. In terms of that 1-year performance, you'll see the percentages down the right hand, but a beautifully balanced portfolio has gone along well. And for those that haven't got the international, so that's the blue and the green, it's been a dark year. I'm talking to a lot of independent retirees who have been do-it-yourselfers, and their portfolios are predominantly cash and Australian shares, and the Australian shares are predominantly banks, and they're hurting big time. Returns of down 17%, getting no return from the cash. So as I say, if you know anyone who might need some help there, as always, we're open and we appreciate referrals and introductions to people who may need our help. So we're going to put everything into context as usual. We use our cycle analysis, that boom bust wall of worry, and I'll give you a heads up, we are firmly at fair value. So we think we're very comfortable at fair value in the cycle. That means there's no real elements of fear or FOMO. It means the markets are in balance to the tune the way we think there's a 75% chance of markets going up and a 25% chance of markets going down, which is the absolute normal. Now, there's a wide range of factors around that, depending on what happens with vaccination outcomes and speed of which travel comes back will determine how quickly the market accelerates from here. And if we have some bad news on vaccines, and if the vaccine never comes, it might be a bit slower from here. And I'll talk more about that in a bit of detail. As always, most of you utilise our CARE methodology, which allows us to have 4 parts of the portfolio that all have different purposes. In constructing these, it's over nearly up to 20 years now we've been running this methodology. But a big part of it is learning from history. Cycles and volatility are inevitable, and putting into perspective current events and media so you can make smart decisions. And as always, we use that framework of mess it up, Most people do mess up their investing, and the two ones I'm focusing today, not in great significance, but I'm reinforcing the media. You're going to see the media love big headlines in the next week around US election. They were pretty big on record debt and stuff like that in the budget. I'm going to put that into perspective. And the single issue marches on, which is coronavirus. It dominates everything. It's very hard to have a conversation with anyone without talking about coronavirus, travel restrictions, border closures, and all those things that we're totally sick of. So the 2020 budget summary. This budget was released 6 months late, because when they would normally release it was right in the middle of the eye of the storm of the coronavirus. So they pushed it out, and wisely so. And a budget is just the government's forecast of what's going to be coming in, their income, what's going to be going out, their expenses, and that leads to their either surplus or deficit, and also things about what's happening to the debt. It's a tranche for whoever the ruling party is and Treasury to put down their policies and cost those and show us what it looks like. So the big things out of the budget where there's massive government spending. So particularly around infrastructure, that's going to help get the economy moving. So they're focused on getting the economy moving. One, by that spending. Two, by incentivizing business with tax cuts. Some massive tax cuts to get business moving on spending and investing, which will help to bring the economy forward. And individuals, so you and I have been incentivized by tax cuts. Now, anyone still working, these tax cuts are up to $2,500 a year per person, and they start at about $1,400 a person. For lots of our clients who are independent retirees, you have the good fortune to be generally not paying too much tax because of the zero tax rate on super, but there's nothing in this budget for you. But I would point out there's also no negatives. So all the bad news of the last few years where we're waiting to see if they were going to tax super more and other investments, that's kind of gone. So there was nothing really in it for independent retirees except hopefully getting the economy going, which helps your investments. For those working, some nice tax breaks, which will help get people spending, hopefully, and business incentivized by tax breaks as well. Now, to get unemployment down, and unemployment's pushed up around the 10% level, depending on how you measure it. Natural unemployment's closer to 5%. So unemployment goes up much quicker than it comes down. So a key part of the next few years is trying to get people back to work so that we don't have a massive class of people that are unemployed for long terms. One of the key ways they're doing that is massive incentives to hire around traineeships, around apprenticeships, around people who've been on JobKeeper. So there's massive incentive. I mean, a good example, if someone hired a trainee and they were paying them $56,000, you can effectively have half of that paid by the government. So that's a big incentive, and that is going to get employers hiring. And I know for ourselves, we'll look at that in our hiring decisions over the next year. Now we're going to produce big debts. I'm going to talk about that in a minute. But interest rates are low. As I said, 10-year government bond rates are 0.5%. So the government's only paying interest on this debt at 0.5%. So compared to the GFC when 10-year government bond rates were closer to 6-7%, it's so much less. And I want to put context. You'll hear numbers thrown around by the media, billions and trillions, and it sounds like a big number. But there's 25 million people in Australia. So every $1 billion of spending is $40 per person. Not a significant amount. It's still real, don't get me wrong. Every $1 trillion is 40,000 per person. So when you hear the opposition and others in the media talking about a $1.7 trillion debt as if it's the end of the world, it's about 69,000 per man, woman and child in Australia. Now, when economies are down like they are at the moment, that's when we need the government to take over and spend. And as the economy comes back, we need them to wind back that spending, increase taxes, and rebalance the budget again. And hopefully that's the way the next decade plays out. But as always, it's a suspense. Just some curious factors. I did a presentation to the Noosa Association of Independent Retirees, a fantastic organisation that keeps their members up to date with all sorts of issues. I've been doing that presentation for nearly 20 years. So I've got a few slides out of that presentation, but it was about an hour and a half on the budget and the future. If you're interested, give me a hoy. I do have the slides from that. But you'll see, where does our money go in the budget? 1/3, 33.9% of all government spending goes to social security and welfare. That, by the way, does not include JobKeeper. It includes the dole, age pensions, NDIS, all the subsidies that go to welfare in Australia. This has become a permanent cost. It's the price we in Australia pay for having a society that is reasonably, what's the right word, civil, social, where we do look after people that haven't done so well. For those of you that have travelled to the US in recent years, you will have seen the massive amounts of homeless people in very affluent cities like San Francisco, Seattle, LA. We have little bits of that, but nowhere near as much. And yeah, I do credit our social security for that. Sometimes we complain about the taxes, but it does allow us to live in what I think is the best country in the world. That's our spending. That's not going away anytime soon. Put all that together and you'll see these columns here. The 2019-20 was what actually happened to the end of June. So keep in mind, this was the budget that was going to be bringing home a surplus. A modest surplus of about 7 to 8 billion was the forecast. We ended up in deficit of 85 billion. Keep in mind, $40 for every person. So that's 3,200 deficit per person. Not tragic. And it was caused by the pandemic, pure and simple. The budget deficit for this year will probably be about 213 billion, and you'll see it slowly dropping, but this is the annual bit. So that's going to push debt up, and you'll see debt rising up to, and this is net debt, up to about nearly $1 trillion in 2023. But as I said, $1 trillion, 40,000 per person. While it sounds alarming when you hear the numbers trillion, it is something that we have full capacity to get out of. And the good way to measure debt is as a percentage of GDP. And this chart on the left shows that. And you'll see, we had post-World War II debt as a percentage of GDP at about 160%. It's been back sub sort of 30 and 40 for a long time, but we've just gone bang straight up to 60. And some economists, including Shane Oliver from AMP, estimate that that's going to get to about 70% of GDP. So while it's high, it's not alarming. And Australia starts this in a really good position. If you look at the chart on the right, you'll see Australia is very low compared to other countries. The US has debt levels that will go over 100%, which is much, much higher than Australia. The Eurozone, 60 to 80%. Japan's had high debt for years, and that provides a massive handbrake on their economy. And the average for the OECD advanced countries is in the 80%. So Australia's in a relatively good position compared to other countries, which bodes well for our future. But this is the chart that I find fascinating. So the top line here comes from pre-COVID potential of where GDP was going. So GDP on the left and right hand scale was cruising along at about 480 billion, then bang, it fell off the cliff. That's what a recession is. And it went back to about 2017 levels. And that's about where markets went to as well. Now you'll see with all the spending, the bottom line here, the GDP comes back and Treasury has it forecast hit pre-COVID levels somewhere in 21, 22. And some people might say that's a bit ambitious, but let's say it does. My base case says, well, if GDP is back to those normal levels in 21, 22, that would have the markets back to those levels as well. So that would take us up another 1,000 points on the ASX 200. So it'd be a nice steady 8, 9, 10% return per annum from there. Now, there's a lot that can happen. That's not guaranteed. We can get there quicker. It might go up quicker. But as I say, the worst case is vaccines don't roll out as quickly or they're not found at all. We have repeated 3rd, 4th, 5th, 6th waves and repetitive shutdowns, Victorian style, that keeps shooting the economy till eventually we let this thing go. Now, hopefully, the base case is vaccine comes along, it rolls out over the next 12 months slowly, increases in capability of test, trace and vaccinate mean we get back to a relatively normal life. But the point I want to show here is look at that top line, look at that bottom line. That's a difference of about 8%. So that's what was wiped off the global economy, and that's never coming back. So the new normal is that bottom line. Now, it does go up, it is growing, but what we've done is just had, what we'll have had is effectively 2 to 3 years wiped off the world economy. So we'll be effectively starting somewhere in 21, 22 at where we were in sort of 19. Now, the good news is we've done the medicine. We've done the downturn. We now get the normal upside with all the usual volatility. So that gives me confidence for long-term investors. Now, there's definitely going to be short-term volatility. We've got presidential elections. We've got vaccination, the wait and suspense. But in the long run, human nature is hardworking. We want to build companies, make profits, and that pushes up GDP around the world. How quickly remains to be seen. As I said, we're also going to see massive incentive around people borrowing. So APRA's allowed repayment holidays to extend for up till March 31st before they penalise. Normally, if a bank has bad loans, it's got to put more capital aside. So that means they can't lend as much. But APRA's the regulator of the banks. APRA's excused the banks from that at least till March 31st. And I suspect they'll keep extending that to a degree. And as I said, the RBA is focused on cutting borrowing costs, which will help both businesses borrow to invest, but also individuals borrow to invest. And those things are good for markets. So let's run through quickly the markets. Aussie shares, as I said, they were down 3.5% for the month, but you'll see, they've risen strongly. You'll see from that last bar, they've jumped back up again. Even though down at the time I did this chart, but sitting at about 6,200 at the moment. 10-year returns, 5-year returns, sitting at that high 6s, 7s. In a low inflation return world, that's pretty fair. We're down 10% for the year in the Aussie share market, so very important that we've had international shares to help out there. Now, for each of the segments that I show here, I've put in some extra information to show you the level of diversification here. So within say the ASX 200, within VAS, which actually has 300 companies in Australia, you get massive diversification. The price to earnings ratio on that is about 18 times. Now that's just the multiple of the earnings of those companies. The return on equity is about 13% and the earnings growth rate about 8%. So lock those in as I go through and compare some of these. They won't necessarily mean a lot to you, but it's relative for different markets. So the Australian market, a price earnings ratio of 18. The US shares, VTS, which we have in the core portfolios, it was also down about 3.5% for the month, but up strongly for the year, about 15%. Predominantly due to partly currency and partly the big tech giants. And you'll see VTS has 3,500 companies in it. That is a massive amount of diversification. Dividend yields in the US are much lower, 1.67% compared to about 3.6%, and that's before franking credits for Aussie shares. So lower dividends on US shares, but higher growth, much higher price earnings ratio. But there's also a much higher return on equity, so some would argue that's justified. It's a whole textbook on what all these things mean massively, but I'm trying to give you a bit of an insight. So for US small caps, they've been a bit like Australia. They're down about 13% for the year after having an amazing 5 years, and you'll still see the 10-year return still at 14%, but the more recent returns have gone down. And this is the mid-tier of companies in the US. So there's 600 companies that make up this, and these are the fast-growing companies. So in the long run, small companies outperform big companies, but in the short run, they can be more volatile, particularly in volatile times like we're having with COVID. Their price earnings ratio about 16, so lower than the broader US share market, which had a price earnings ratio of 26. So that tells us they're a little bit cheap relative to other sort of things. So we're comfortable with that going forward, particularly as they'll outperform in the long run. So global leaders, this is the top 100 companies in the world. So this includes those big ones, Facebook, Microsoft, Amazon, Apple, Alibaba, Tencent. And you'll see a similar story to the US market, fairly high price to earnings ratio and fairly low dividend, about 1.7%, down for the month, but recovered in October. Emerging markets is a mixed story. So emerging markets are now positive over all time frames. They were up for the month, up for the year, up for the 3 years, but still modest returns. And emerging markets, we do always expect to perform better than the big country markets over the long run, but once again with more volatility, particularly when there's trade wars. But emerging markets in the last year, that recovery has been dominated by some of the larger holdings in emerging markets, which are the powerhouses of companies like Alibaba and Tencent, and they're like the Chinese Googles and Facebook, so massive companies. So price earnings ratio is lower here as well, so we think that makes them fairly fair value. Gold has been an incredibly important part of the portfolio. It's allowed our active portfolio to continue to deliver positive returns in the last year. And gold, the red lines there just show you all of gold's increase happened from sort of 2019 through to the start of the pandemic. It was pretty flat in the lead up to that, and it's been pretty flat since. So we would never suggest people go and put all their money in gold. It produces no income, but as a small part of the portfolio, it provides a nice insurance. And as I show, that active portfolio, I'll show those returns again in a minute. So let's reinforce the case for a rising share market. Low interest rates, as I said, make equities more attractive just on the valuation basis. If you're getting 0.5% in a term deposit, you're willing to pay a bit more for Commonwealth Bank shares, and you might see that dividend go from 6 to 3%, which means the market's going up. So interest rates will switch to high yielding stuff like shares. Low interest rates also encourage more borrowing. That encourages investing, and that's good for both shares and property market. And I'm going to talk about property markets in a minute. Human nature, we can't help but spend. When we can't travel, we buy other things. I note from talking to many of my clients, there's a lot of new caravans being bought. There's a massive waiting list for caravans. Here on the Sunshine Coast, trying to get builders to finish jobs is a nightmare. They're all doing renos and new buildings for people, so we've got a shortage. And so money's being spent. That's a good thing. That's going to help the economy recovering. And as I said, the government and the RBA in Australia are backing that with spending and money printing, stimulus by the RBA and the Federal Reserve in the States and all the federal banks around the world. So that's all the positive side. And if we get confidence, it won't take much. If we get a stable US election result, if we get vaccines start to come out into trials and then start to roll out early in the year, you may actually see the share market rise very strongly. They're two big ifs, by the way, and they would be our best case. Our average case is for that steady grind back over the next few years, but with good solid returns, and certainly far in excess of interest rates. The down case, the negative case, is we don't know how long this thing lasts. So that will depend on vaccines and the speed in which we get back to normal. As you saw, the Australian Treasury think that's somewhere in late 21 to 22, and that's fine by me. That says markets will appreciate over that time. But yeah, if it spans out longer, then the market returns will be lower. We don't know that time to recovery. We don't know if the vaccination will be successful. I might have mentioned last month, but I'll say it again. Some analysts who we rate, who analyse the airport and airline industry, they don't expect the volume, that's the levels of international travel, to get back to pre-COVID levels till 2026. Now, that doesn't mean people aren't travelling till 2026. It just means not as many, so we won't hit the sheer volume until about 2025, 26. Who knows? If we get more trade wars back, part of that may depend on the US election. The markets think there'll be less trade wars with Biden and the Democrats. We'll wait and see. We are in the midst of a long-term shift and fight for power between China and the US that will go on for the next 100 years. So we're going to see little skirmishes on the trade war front as normal. And let's hope politicians keep their head through all this. And as always, one of the biggest dangers for share markets is another potential black swan. But generally, we think the cases are fairly well balanced. As I said, there's those performance numbers again, and you'll see that that active portfolio, which has averaged about 9% over the last 5 years. So that's a portfolio where we aim to have some downside protection. And you'll see for the 1 year, it's tracking in the positive, not massively, but still the positive. But over 3 years, 9% as well. So it's an important part of those portfolios. So happy with returns, as happy as we can be in a market that's not growing strongly. Property prices are pretty stable around the country. The only city that's still dropping is the predictable one of Melbourne, just sheer due to lockdown. Everything else is heading up, and you'll see Brisbane up about 4% for the year. Adelaide up about 3.6%. Sydney strongly up for the year. Melbourne's still up for the year, but down in the last 6 months. And probably you see a lot of different commentators talking different things here. I actually think property is going to be fairly stable. Property is driven by economic growth and population growth, so it's going to be very different in different markets. If we do see people move from Victoria to northern states, which there's anecdotal evidence that there will be. One of my clients who's in real estate in northern New South Wales on the hinterland of Byron Bay says people from Victoria are buying sight unseen and talking about moving up post-COVID. Now, whether they do or don't, it's certainly kept the property market in nice areas like the northern New South Wales, Sunshine Coast, very buoyant at the moment and quite healthy. Our friends at Heron Todd White show that. You'll see the rising market there is dominating on the left, so there's more places rising than are falling, and you'll note the places that are falling are still capital cities predominantly, and the places that are rising are generally nice places to live. Ballina, Byron Bay, Coffs Harbour, Lismore, Mackay, but they're people that were going, wow, if we're going to have this sort of stuff, I'd like to live there. Now, whether this is long lasting or temporary, the human nature has the ability to forget these things very quickly. So we'll see how that goes long term. We're also seeing Perth recover as the West Australian economy is doing the best out of all of them, partly because of the mining industry holding up incredibly strongly. So it's an interesting property market, and with low interest rates at the moment, there's certainly plenty of reasonable opportunities for buying, but as always, be careful. Happy to talk through potential locations that are probably going to be more hesitant to use the word certain, but more likely to have decent returns over the next decade. And as always, property should be a long-term investment. The cases for units, very similar as well, more rising than falling. Units are interesting. Will units be on the nose after all this, or will we all forget? Remains to be seen, as always. So just want to finish up, as always, by reinforcing the process for, the number one thing we emphasize to everyone is that all investing is best done as part of a real financial plan where you've got goals based on your life and the things that are important to you, and the portfolio is designed to meet those goals. We take a long-term view. We make sure we've got massive diversification. You've seen some of that today with some of those holdings. The right asset allocation, and that's the exposure to the right sectors. Plenty of liquidity and low cost access, so we want to keep costs down. We want to make sure that every cent of cost we're paying is valuable, and protect against that short-term volatility through our reserves for our retirees, and that just means we keep 2 to 4 years worth of spending needs in short-term investments so that we never have to sell, and dollar cost averaging for our people that are building wealth towards retirement, which has been a fantastic strategy this year because we've got to buy lots of good quality investments on special when they were down. And we rebalance regularly as an investment committee and when we sit down with you. And as always, I'll finish on that last point. There is only 3 ways to lose money in the market. Don't do it. And they are panicking and selling at the wrong time, having to sell and not being properly diversified. When we're properly diversified and we don't have to sell because we've got enough liquidity and because we've got a good plan, and if we never panic and sell, we do hit those goals. Thank you for listening. I hope you're all doing well. Look forward to talking to you at some stage soon. Can't believe we're building up to Christmas. My next one will be, we'll sneak 2 of these in before Christmas so I won't start wishing you a good Christmas, but we're getting into a good part of the season. Thank you as always for listening. I'll talk soon. Rob McGregor signing out.